our review. Welcome back, candlestick traders. I'm Lance Beggs from yourtradingcoach.com. In today's video, we'll continue our review of the multi-candle reversal patterns with the bullish engulfing pattern. The bullish engulfing pattern is a two-candle pattern occurring at market bottoms only, so it's a bullish reversal pattern. The price action leading up to a bullish engulfing pattern must be a downtrend. Ignore the pattern in a sideways trend or an uptrend. Price must be trending downwards. The first candle has a red real body continuing the trend in the downwards direction. And the second candle is a green candle opening below the real body of the red candle. So opening here below the real body of the red candle and closing above the real body of the red candle. So the green candle closes here above the real body of the red candle. In other words, the green real body engulfs the red real body. Confirmation of the pattern is price trading above the high of the green candle, above this point here. As always, more conservative traders may seek additional confirmation through price closing above the high of the green candle. Whatever works for you when you're back and forward testing is fine. Let's look again at the sentiment or the psychology of the bullish engulfing pattern. Who is in control this time, the bulls or the bears? A little hint once again, maybe the name bullish engulfing pattern helps. However, once again, let's work it out. The first candle continues the downtrend. Everything is looking bearish at this stage. The second candle ideally gaps down at the open. Not essential and not possible in some markets such as intraday forex, where it might be at an equal level or within a pip or two. However, price is at an area now that shows a change in the balance of bulls and bears. Bears are no longer willing to sell the market at these low prices, at least not with the dominance they showed before. In fact, some of them may be entering a buy order to cover their shorts. The bulls find these prices attractive and enter the market in more force. The balance of supply and demand has tipped slightly more in favor of the bulls, and price rallies. The key to this pattern is the closing of the green candle above the open of the red candle. The bulls are able to strike a massive blow to the bears. This will shake the confidence of a number of the bears, leading them to exit their short positions if the pattern is confirmed on a break of the high here, and it will strengthen the confidence of a number of bulls who will also enter on achieving that confirmation, helping to continue the bullish move upwards. Let's see how the process of candle addition changes a bullish engulfing pattern into a single equivalent candle. The bullish engulfing pattern is made of one candle of price action that opens here, moves to lows here, closes there, followed by a second period of price action, gapping down to open here, and in this example closing right on the top, right on the high of the green candle real body here. The same period of price action for these two candles displayed on your screen. Is equivalent to this single candle here, where price opens at the base of the green real body here, equivalent to the open on the red candle here, moves to the lows, equivalent to the low of the bullish engulfing pattern, and closes on the high, equivalent to the close of the bullish engulfing pattern here. So what does this single candle represent? Remember, it occurs at the bottom of a downtrend. That's right, a bullish engulfing pattern through the process of candle addition becomes a green hammer. Once again, a bullish reversal pattern. So which is more bullish at a bottom reversal pattern, a bullish engulfing pattern or a piercing pattern? Well, the best way to answer this is to resolve both patterns into a single candle via candle addition, and then compare the single candles. We established just a short while ago that a bullish engulfing pattern here is equivalent to a green hammer through the process of candle addition. And we established in a previous video that a piercing pattern was equivalent to a red hammer through the process of candle addition. Well, in the hammer video, if you recall that, we established that a green hammer is more bullish than a red hammer. So that means a bullish engulfing pattern is more bullish than a piercing pattern. It's fairly obvious anyway through looking at the pattern. In the bullish engulfing pattern, the bulls were able to push price up, closing it above the open of the red candle. So closing at this point here above the body of the red candle. Whereas in the piercing pattern, the bulls were able to push the price to close above the 50% level of the red candle, but we're not able to close above the open or above the top of the red real body. Let's look at a few examples. Firstly, British pound US dollar 4-hour chart. A previous area of support at the 1.9600 level. Highly volatile failure of the breakout below the support level. And up. A downtrend. Right back into the 9600 support level. The price then creates a bullish engulfing pattern and a nice rally which continues beyond the right hand side of this chart all the way up to the 2.0s level, round number resistance for a 400 pip move. So we had a bullish engulfing pattern right at an area of proven support. It doesn't get much better than that. Note, if you can see the picture on the screen, that the open of the green real body is actually just 1 pip short of fully engulfing the red candle. That's cool. We rarely get perfect examples, especially at Forex where price rarely gaps. The open of one candle will usually be 1 pip above or below the close of the previous candle. So, as discretionary traders, we need to allow some flexibility to the patterns to accommodate the nature of price movement in these types of markets. Okay, this British pound US dollar daily chart example is chosen to remind you that while we say we require a downtrend leading into the bullish engulfing pattern, it can also be found at the bottom of a retracement in a larger uptrend. The key point is that price is trading downwards leading into the pattern. Here we have a larger uptrend, price retraces, fails to carry through, and retraces for a second wave, stopping in a lot of short entries just below the swing low here. A bullish engulfing pattern creates massive fear for those entered short, and confirmation as price trades above the high of the green candle here, along with stopping out the short traders above the swing high here, helps to propel price higher again for a great move up to new highs. And mini Dow 15-minute chart downtrend. Leading into a bullish engulfing pattern. Price rallies, stalling at the previous area of support, now resistance, comes back for a retest of the lows and a second bullish engulfing pattern. This time the rally takes price through the resistance and continues higher. That's it for the bullish engulfing pattern. Coming up in the next video, we'll get started on the final part of our free candlestick video series, the 3 candle reversal patterns. I'm Lance Beggs from www.yourtradingcoach.com, wishing you as always happy candlestick trading.